Today we continue with the conceptual framework of financial reporting. This discussion today is going to be based on the qualitative characteristics that make information useful. Now remember, this is part of the new 2010 framework. It's been updated. So just understand, qualitative characteristics of useful information identify information that will be most useful to investors as per the objective and lenders for making decisions based on financial reports. To be useful, financial information must have the following two fundamental characteristics, namely be relevant, and information must faithfully represent what it purports to represent. In addition to this information usefulness can be enhanced or have enhancing characteristics, and it must be then comparable, verifiable, timely, and understandable. Remember, all of this is based on the new 2010 framework. So if this differs a little bit to what you've seen before, it's probably because you looked at the 1989 framework and its qualitative characteristics. So let's quickly just do a comparison. The 1989 framework had the following qualitative characteristics. All of them were applied equally and had the same prominence. First of all, you had relevance, then you had reliability, comparability, and understandability. Under relevance, you would also discuss things like materiality. Under reliability, you would also discuss items such as prudence. Now, comparability and understandability we'll discuss shortly. Now, under the 2010, the new improved framework, phase A, has been completed. There are now two types of qualitative characteristics, namely the fundamental qualitative characteristics and the enhancing qualitative characteristics. The fundamental still has relevance as the primary qualitative characteristics. Now that's incredibly important because remember, the objective talks about information being made available to users for their decision-making process. Therefore, that information must be relevant. Now, there was a lot of discussion and debate in the old framework, and there was always this trade-off between reliability and relevance. So reliability, what's more reliable? The fair value of a building is more reliable. But often that fair value had to be estimated. So then reliability would be discussed, and there was this misconception that reliability was purely focused on accuracy. And obviously estimates of fair value, well, they're an estimate. They're going to have some type of error. So then the historical cost camp would say, well, that fair value is not reliable. So therefore now reliability has been removed and has been replaced with faithful representation. Okay, those are the two fundamental characteristics, and in order for information to be useful, it must be relevant and it must faithfully represent what it purports to represent. Please take note, however, this is applied with relevance in the primary kind of role, and then faithful representation being secondary. Now, in terms of enhancing characteristics, these characteristics don't have to be always present, but they do enhance the usefulness of information. Comparability, well, that's remained. Nothing's changed there. Verifiability is new. Timeliness is new. And understandability, well, that's still the same. Now we're going to go and discuss some of these individual items, starting with relevance. So, relevance, well, information is relevant if it makes a difference in the decisions made by users. So if users will use that information and it will affect the outcome of their decisions, it's relevant. Information will make a difference in decision making if it has the following two values, namely predictive value or it may have or may be relevant if it has confirmatory value and sometimes information may both have predictive and confirmatory value. So revenue gets published in the financial report at the end of the year, and it may have confirmatory value for analysts looking back at what their analyst expectations were based on all their analysis and management projections, and that may have as well predictive value because that revenue figure may work as a forecast for future revenue. So relevance, the absolute key here is something relevant? Well, if it would have affected decision makers' decisions, then yes, it's relevant. So the standard, the framework, talks about predictive value of information if the information can be used as an input for users making predictions. The biggest one here will be your net profit or some type of earnings figure that will go into a valuation model possibly. Confirmatory value will provide feedback about previous evaluations, which is probably based on predictive values and models. Under relevance, there's a little subheading that refers to materiality. Now this is probably more important for your auditing, but you need to understand materiality when you're doing financial statements in the real world. So information is material if it's omission or that information's misstatement could influence decisions. Remember, this is a entity-specific concept. Okay, it's based on either magnitude or nature or a combination of the two, and it's in the context of an individual entity's financial report. And just what people battle to get their head around is that the IASB can't give a quantitative threshold and say all figures above 1,000 currency units are material. Well, materiality is all going to be relevant. So an item of 1 million that gets understated in revenue, for a small company, that's definitely going to be material. But for a large listed company such as Coca-Cola, if there's an understatement of revenue by 1 million, well, that's not even going to be a rounding figure in reality. It's definitely immaterial. Very important concept to understand in the practical world and your auditing side of things. Next up, we're going to discuss faithful representation. Information must faithfully represent the economic phenomenon that it purports to represent. 3 characteristics for perfect faithful representation. Take note, I'm saying perfect faithful representation. First of all, the information must be complete. Second of all, information must be neutral. Take note that under the old qualitative characteristics of reliability, there was a concept of prudence that was discussed. That's been removed, and now there is only neutrality. And then there is the third characteristic, namely the information must be free from error. Now, in the real world, this is never possible to be perfect, but you must try and maximize these 3 characteristics. So complete means that there must be all information available or necessary for a user to understand the underlying economic phenomenon, the transaction or the event or the circumstance. Neutral means that it must be free from bias in the selection or presentation of financial information. Now, that means I must not have someone behind the scenes trying to manipulate either the inclusion or even the presentation of that financial information in order to get some type of favorable or even an unfavorable response. Free from error does not mean accurate in all aspects. Okay? Sometimes I might have to do a valuation, okay, on an unlisted company where there's no observable inputs. Well, there, I don't have enough information to say if something is purely accurate, because it's a model, it's an estimate. But what free from error does allude to is that the information is given to the user that it's an estimate. Okay? That the estimate methodology and the assumptions behind that method are given and disclosed, and that the application of that method is not full of errors. That the application is free from error. So those are three very important characteristics. Remember, no longer reliability, but we are now dealing with faithful representation. I think this has been a good move by the standard setters. Okay, application of these two fundamental characteristics are: first, identify the economic phenomenon that has the potential to be useful. Then you must identify the type of information about that phenomenon that will be most relevant to users. And then you must determine if the information is available and if it can be faithfully represented. Now onto the enhancing characteristics. Here I'm going to go a little bit quicker. These are quite straightforward. First of all, let's discuss comparability. Information is more useful if it can be compared with similar information about, first of all, other entities, so in the same year across 5 different companies, for instance, or for the same entity for another date. So maybe I need to look at the revenue figure for the same company for the last 5 years to work out forecasts and trends. Please take note that this is not the same as consistency. Comparability does not mean consistency. Consistency refers to the use of the same methods for the same items from period to period. Comparability is the goal, and consistency helps us achieve this goal. Mainly here we're talking about consistency amongst our accounting policies. Uniformity is not the same as comparability. Uniformity says everything will be treated as the same. So like and unlike, okay, are treated and look alike. Whereas comparability says that like things must look alike and unlike things must look different. So if I have revenue from services, all revenue from services must be comparable. But I must not try and make revenue from sale of goods look the same as revenue from services. So that is the difference between uniformity and comparability. Verifiability, one of the new enhancing characteristics. Verifiability can be thought of as follows. If different knowledgeable and independent observers could reach consensus about the amount recognized, the presentation and disclosure. So consensus does not mean complete agreement. Okay. Also, we also understand that when I'm trying to verify a number, it does not mean that everyone in the room, all experts, will come up with the exact same number. Say, for instance, we're again talking about the fair value of an item of PPE. But what it would mean is that all those people would come to a similar range of values in their estimate of that fair value. That would be verifiability. Verification can be direct or can be indirect. Direct verification would be through observation. So I would verify the share price of company XYZ Limited listed on the Johannesburg Stock Exchange at year end by inspecting the price or observing that price on year end. Indirect, however, would mean that there would be some type of model and I can check the inputs or the assumptions to that model. So I might be dealing with an unlisted company, and how would I verify, or what would be the verifiable fair value? Well, that unlisted company would obviously have a valuation model that someone did. I would then get the valuation model, and I would go and look at the inputs. I would verify the discount rates. I would go and verify the reasonability of the assumed cash flows, etc., etc. Now, some information, it may not be possible to verify until a future period. And whenever that is the case, it will be necessary to disclose any assumptions, the methods for the figure obtained, and any factors and circumstances surrounding that figure disclosed in the financial statements. Timeliness, very straightforward. Information being available to decision makers in time to be able to influence their decisions. If information is timely, then people will use it in their decision process. If it's 6 years out of date, then they won't use that information. It's not timely, and therefore it will not improve the usefulness of that information. So generally, the rule is the older the information, the less useful it is. Sometimes that's not always the case. Sometimes a bit of information will continue to be useful for years, but more often than not, if information gets older, it becomes less useful. Understandability, also pretty straightforward. So what makes information understandable? If classifying, characterizing, and presenting information clearly and concisely, if that is done, that will generally improve the usefulness of information by making it more understandable. Please note that there is an assumption, however, in accounting. Remember, we're not going to be dealing with a totally uneducated user of financial statements. Here we will assume that the reader or user of those financial statements will have reasonable knowledge and will take the time and effort and be diligent about going to research that bit of information. Just because information is not necessarily understandable to everyone, well then, that does not mean you don't leave that out. If you have a look at some of these investment banks listed in the US or even in Europe and South Africa, their financial statements are incredibly complex. If you look at their financial instruments they hold, all the derivatives, such as the futures, options, the warrants, those are complex. Those even the average qualified accountant doesn't understand. Just because it's very complex doesn't mean we leave it out. No, it doesn't. You will try and make that information as user-friendly or understandable as possible, but there will come a time and place where that information will just go in its form. Now, overall, please remember that there is no such thing as a perfect set of financials. Why? Because cost is this pervasive constraint that always has to be kept in mind. Reporting financial information imposes costs. Accountants are very expensive. Expert corporate finance and valuers to get the assets valued are very expensive. Every bit of time spent by external consultants costs money. Internal people are paid salaries, and there's opportunity cost of them not doing something else. Now, any costs incurred by preparing those financials must be justified by the benefits related to the reporting thereof. Thank you.